Welcome. My name is Randy Helm. Today's topic will be on the income statement. We will cover the basic layout from the top line to the bottom line. Some of this information might be new for you, so feel free to watch this video as many times as you'd like. So if you're ready, let's begin. Here we are looking at an income statement. It is also known as a profit and loss statement or a statement of operations. It can go by different names, so try not to get bogged down by the name. Let's go through the basic components. First, let me state that this report represents a length of time, not just one day. It represents the summary of the transactions for a month or a quarter, which is 3 months, or maybe a full year. It is not a point in time, but rather it covers a period of time. You can see here we are looking at the report for the year 2020. This report covers the 12-month period of calendar year 2020. The revenue is $700,000 for the year. Sometimes that is called sales. Sometimes it is referred to as the top line. It can go by different names. We will stick with revenue for now. That is the most common term that accountants use. The revenue number represents things that you sold. If you have a store, it is the merchandise that you sell to your customers. If you run a bar or a restaurant, it is the liquor and beer sales or meals that you provide to your customers. It could also be services that you provide to your customers. If you have a consulting business, it is the services that you provide. If you are a real estate agent, it is the commission you earn by helping your clients buy and sell homes. Revenue roughly means the business you have taken in from your customers. The next line is the cost of goods sold, sometimes called COGS, sometimes called direct cost. The COGS is the cost for the specific good or service that you provide. It is the cost of the revenue. For instance, if you are a retailer, it is the cost of the merchandise that you bought from your supplier and then turned around and sold to your customers. The revenue of the merchandise sold is on the top line. The cost of the merchandise sold is on the second line. If you're in a bar or a restaurant, the COGS is the cost of the food and drinks that you provided to your customers. The difference between what you paid for the goods and services and what you sold it for is your gross profit. In our example, the gross profit is $375,570. This is the amount of money left over so that you can pay for all the other expenses that show up on this report. The percentage that is shown on the next line is the gross margin percent. The formula for this is simply gross profit divided by the revenue times 100. This is a number that gets a lot of attention and is one of the common measures of how well things are going. The next section is sometimes called the overhead expenses, sometimes operating expenses. Sometimes this is called selling, general, and administrative expenses, or SG&A for short. This includes things like paying staff, building rent, utilities, supplies, and a lot of other stuff. These are the costs to support the overall business. The specific lines in our example are probably different than what you see on yours. Each company will be a little different. It comes down to what is important for your business. In this example, you see salaries and benefits. That could be your wait staff at the restaurant. That could be pay for your sales staff. It would also include the cost of any benefits that they might receive, such as health insurance. Rent is a common line to see in this section. Sometimes utilities are shown separately. Sometimes they are lumped together as building-related expenses. How you show this is up to you. Supplies and miscellaneous expenses seems self-explanatory. It could be paper and other office expenses. If you supply coffee to your employees, that will go here. We also show depreciation in this section of the report. We will have a separate video just to discuss depreciation and fixed assets. That can be a big topic all by itself. In short, it is the spreading of cost for your large equipment over several years. For instance, if your company owns a company car, you do not just expense it entirely at the time that you bought it. You basically write it off over a few years. That is what depreciation represents. This is the amount being expensed during this year. Depreciation could also be for things like a building or maybe a walk-in cooler at your restaurant. The interest expense that you see here could be interest on a loan with your bank. It could be interest on a credit card used to purchase some of your supplies and equipment. The line with the label total expenses is the total of expenses from the salaries line down to the interest line. It does not include the revenue or the cost of goods sold. The line earnings before tax is a subtotal of all the activity above it, including the gross profit. In this case, you see $19,962, and it is inside of brackets. The brackets are the accounting way to show this is a negative number. And in case you didn't know, having negative earnings before tax is a bad thing. That is not what you were hoping for. After the earnings before tax is a tax expense line. Often this is not exactly what you paid, but a close approximation. If, on average, you pay about 28% in taxes, you would see a value here that is 28% of the earnings before tax. When you subtract taxes from the earnings before tax, you land at your net earnings. Sometimes it is called net income or net loss. In this case, it is a loss of $14,373. This line is sometimes called the bottom line. Your top line is the revenue, and your bottom line is your net income or loss. This is an important number. Again, in this example, it is a negative number. And that happens sometimes. Hopefully you have a lot more positive net income than you do net losses. The net margin percent comes from the formula of net income or loss divided by the revenue times 100. One way to think about the net margin percent is like this. If your net margin was negative 2%, as it is in this example, that means for every dollar you earned from your customers, you actually lost 2 cents. If your net margin were a positive 5%, that would mean you netted 5 cents in profits for every dollar of revenue. This is an income statement for 1 year, all by itself. What you should be doing is comparing the current income statement to the prior periods. Compare this year to last year. Look to see what trends exist. Are you improving your business? Are you just holding steady? Or is it even slipping backwards? Now let's take a look at this year alongside the previous year. This gives us an opportunity to really compare multiple years and look for trends. You can see that the revenue was about $1.4 million in 2019, then dropped to $700,000 in 2020. That appears to be moving in the wrong direction. Wow, that is a huge decrease from 2019. 2020 had revenue of about $686,000 less than in the previous year. The cost of goods sold also decreased, which makes sense. You sold less merchandise or provided less services in this new year, so those costs would also decrease. You can also see that the gross profits have decreased. Gross profit went from $734,000 in 2019 to $376,000 in 2020. The gross margins have remained fairly stable. You also see that salaries dropped quite a bit. Now, is this good? Is this bad? You need to dig into the details to see if this matches up with what you were expecting. It does make sense that when a company decreases revenue by this much, that they would need to reduce staff to a level that the business can support. Now, rents stay the same. Often rent is considered a fixed cost in that it does not vary much with the business level. We will go over fixed and variable costs more in a separate video. The supplies have decreased a bit. With the reduced revenue, it is not surprising to see that less supplies were needed. Depreciation has increased. This suggests that the company has purchased some additional fixed assets during this time. So now, the depreciation represents some of the assets that the company had during 2019 and some new ones it purchased along the way. Earnings before taxes was positive in the prior year, but is now negative. This is not what we want to see. The tax expense is also negative. I guess this is one small benefit to losing money. You pay less taxes. The net margin went from a positive 11% to a negative 2% in 2020. I mentioned earlier that in 2020, this company lost 2 cents for every dollar in revenue. For the year 2019, this company netted 11 cents profit for every dollar they made from their customers. In the next video, we will be digging into the monthly income statements for 2020 and 2019. We will walk through what happened during this disastrous 2020. Considering that it was the year of the pandemic, it is not surprising that they had a net loss. But we will look into the different decisions that the company made and how it played out in these financials. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. Be sure to look for new videos from me soon. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.